Most people think you need thousands of dollars to start investing. That it's a game played only by people in suits, trading secrets in glass towers high above the city. But the truth is, you can start right now with what might be in your wallet, with $100. Because investing isn't about the size of your starting check, it's about the conviction to start at all. It's about what you do next. Before we invest a single dollar, we need to get one thing straight. Investing is not the lottery. It's not a gamble on a hot stock tip you overheard at a coffee shop. It is a discipline. It is patience. Every legendary investor you've ever heard of, Warren Buffett, Peter Lynch, Jack Bogle, they didn't get rich overnight. They built their fortunes on a simple, powerful principle. They trusted time. When you truly understand that $100, given enough time, can grow into thousands, it stops feeling small. It begins to feel powerful, like the first step on a long and rewarding journey. So where does that $100 actually go? You start by opening an account with a brokerage. Think of it as the workshop where your money will be put to work. For a beginner, you want a platform that is user-friendly, has low or no fees, and, this is key, offers fractional shares. Fractional shares are a game changer.
It means that even if shares of a major company cost $500, you don't need to be locked out. You can buy $10 worth or even $5 worth. It's like buying a slice of a pizza instead of the whole pie. You get the same quality, just a piece that fits your budget. Apps like Fidelity, Vanguard, or Robinhood all offer this, but do your own research to see which one fits you best. Now for the most important choice: what to buy. When you're just starting out, the single smartest move is not to try and pick individual winning stocks. That's a high-risk game even for professionals. Instead, you buy the whole market. You do this with something called an index fund or an ETF. These are essentially baskets that hold tiny pieces of hundreds of companies. Think Apple, Microsoft, Google, all bundled together. The classic choice is an S&P 500 ETF, which tracks the 500 largest companies in the US. For decades, it's averaged about 7 to 10% in yearly growth. It's slow, it's steady, and that is exactly the point. This is where the magic happens. It's called compound interest. Your money earns money, and then that money starts earning its own money. It's a snowball effect, almost invisible at first, but unstoppable over time. Once you've made your first investment, the next step is to make it a habit. Set up an automatic transfer. Even $10 a week makes a profound difference over years. This strategy has a name: dollar cost averaging. By investing a fixed amount on a regular schedule, you automatically buy more shares when prices are low and fewer when they're high. It removes emotion and the impossible task of trying to time the market, because consistency will always beat timing. And yes, your balance will go down sometimes. It's not a matter of if, but when. Every investor faces that stomach-dropping fear when the market turns red. But if you zoom out, you'll see that every single market crash in history has been followed by an eventual recovery. Staying calm during the storm isn't just good advice, it's the core principle of building wealth. So no, you don't need to be rich to invest. You just need $100 and the patience to let it grow. That first step, the moment you choose to invest a small sum instead of spend it, that's the moment everything begins to change. Over time, your $100 grows, but more importantly, so do you. You learn discipline, you practice patience, you start to think about your future in a more concrete way. This is how wealth truly begins. Not with luck, not with millions, but with a single decision.